Hi, everybody. Welcome to another amazing webinar. This time we will talk about artificial intelligence in finance with Eghbal Rahimikia. How are you, Eghbal?
I'm fine. How are you?
Doing well, thank you. So actually now you are in London, right?
Right. Yeah, I'm in London now.
So what are you doing around there?
I had a presentation a few hours ago, and now joining here for again presenting the same thing for you.
Nice. What was the conference there?
It was a finance conference in London, mostly for academics joining for presenting different things: ESG, machine learning, theoretical finance, option trading.
Amazing. Well, Eghbal is in London, but for people who is joining, I'll introduce Eghbal. So, actually, Dr. Eghbal Rahimikia is an assistant professor in financial technology at the Alliance Manchester Business School. His research focuses on artificial intelligence, machine learning, and financial markets overall. And he's the lead author of the paper that this conference will be about, Revisiting Time Series Foundation Models in Finance, which is a 2025 paper studying how series foundation models perform in financial forecasting. So, and this is what we will talk about. Well, not me, actually, Eghbal. And hopefully you're ready. By the way, we will have time at the end for a Q&A. We are live, remember that. But feel free during the presentation to write down your questions in YouTube or LinkedIn or whatever platform that you are watching it, and we will have time at the end to answer most of the questions if we have enough time. So thank you, Eghbal, and I'll be here backstage.
Thank you so much. Thank you for the invitation. So today I'm going to talk about time series foundation models, but there are two linked studies we have been working on that during the last few years. The first one that became quite popular too was revisiting large language models in finance. And after that, we moved to the study we are mostly focusing today, revisiting time series foundation models in finance. The context and the framework of both of them are quite similar. So I'm going to touch the first study a bit to give you a foundation how everything works in large language models. And after that, extend it to the latest study we have been working on that during last year. So revisiting large language models in finance, as I said, became quite popular during last few years. In this study, we started developing smaller models, but using the popular architectures we have in the market, and see whether we really need top-notch, the most complicated, LLMs or chatbots in the market for financial forecasting, or whether it is possible to make our own model with the data we have or not. And we extended later the same concept to time series foundations too. So the framework, the context is exactly the same. The way we are comparing the models are quite similar. That's why I put them together and make a bundle today to focus on both of them. But of course, the major focus here today is time series foundation models. So we already know, especially after the GPT models, they came out, there were trendy research in the market and more focus in the research and in practice in the market to use these models for trading, for return forecasting, to use them to make money. This is the main interest when something new comes out, especially some new theories, some breakthroughs. And this happened when these new generations of large language models, they came to the market. But there are some considerations here, both from the time series foundation models and also large language models. We have just one model in most of the time, and they already saw most of the data. There are some worriness that this may bring look-ahead bias in our study. It's difficult, of course, to make a new model from scratch because you need so much data. These models are quite large, so it's not feasible. That's why you don't have many companies working on that. There are just few companies working on developing models. But there is possibility to make these models much smaller, the architectures more compact, use our own data and see how it works and what benefits it brings for us. In two studies I'm presenting today, we actually focus on these main points. And of course, one of the other focus was look ahead bias. We want to make sure that the performance we are getting from these models is coming from the model, not from the look ahead bias, because there is models they saw data until okay, when we talk about GPT models 2024, 2025, they're always updating. So maybe they already have information inside. So other side of the research was focusing on making point in time models. It means, okay, we want to forecast 2006. We make a model, much smaller models that just saw data until end of 2005, and we apply it on 2006. In both studies, we followed this structure framework to make sure everything is solid. All the performance we see is the real performance of the models. And the other thing that we have to focus on that in both studies is that we need good group of benchmark models. One of the problems we have in AI world now that we have many benchmarks, but benchmark is not showing the reality. Like you see one model coming up, from big companies, you have some experience with that in your area and you feel the benchmarks are always telling it's really good, it's reaching you 99% in this benchmark, that benchmark, but you don't feel the performance in your area and you move back to another model or another chatbot. So we need a proper benchmark related to finance here. We need models too, they have to compete. We have to make a horse race with popular models in the market from LLM side, from time series foundation models, and at the same time from finance too. Like when I'm talking about large language models, we are comparing the models with simple dictionary, with Finbird, with Farm Predict, and at the same time with, big runners in the market too, like Llama and the other like DeepSeek. So we need both sides. We need to be clear that we are comparing these models or making a horse race in a proper way. So what are the challenges? As I said, look at bias. We always have data problem. When you move to model development, you need, even in the smaller scale, when you want to make these models, you need so much data. Of course, you don't need to as much as data like the companies are using because you are making the models much smaller, but still it is essential to have a good mixture of data, but related to your work. So for large language models, we try to mix different popular source of the data that is common to use in finance, in accounting, and in time series foundation models, we use all time series data, excess returns more specifically from US markets and also international market. So hopefully in finance, a good thing is that we have considerable amount of data, both from text and also when we move to the time series from the time series data. And of course, we try to make the models kind of handicapped and smaller and see how they work because we have limitations. We can, of course, all the people, they want to make the largest models in the market, but in reality, you need so much resources and maybe even you don't need it, this extra information in the models, other languages or, multi-modals, image, tag, numbers instead of these models. Maybe it's not even essential for our task. So very fast, for the first paper that we released it in 2024, I think, and revised it last year, we had mixture of the data. You can see a list of them. We have key development data, Dow Jones for the financial news, SEC filings, intellectual properties, transcripts, board information, and also some kind of level of general information from Wikipedia. So we use all this data, we made our own models, much, much smaller. We are talking about 15 million, 75 million parameters, even an older architecture like BERT or Robert. We focus on Roberto. It's not even generative models. But we made a horse race with this tiny model, but with specialized data against big players in the market. So as you see, the models are much, much smaller. When we talk about the other models, we are talking about 8 billion, 10 billion, 20 billion parameters. Here, we just made the models, our base model is just 124 million parameters. And small is even half of that. So this is really important. Older architectures, and at the same time, much, much smaller models. And we try to monitor everything, how much time we need to make these smaller models, what resources we need. We presented all of them in details in the first paper. So both papers, this paper and the other paper, they follow the same thing. We are considering the performance from both sides. One side is statistical accuracy, R squared, and stuff like that. The other one is trading. Of course, we can make a real trading case. So we use zero net investment strategy. So it's a really simple, common way to compare the performance of the models from the trading side, portfolio side. So every day we make a portfolio, $1 long, $1 short, and based on the predicted values we have, and we try to, long top 20 and bottom and short bottom 20. And later we can change these parameters as we need. So we make these models. For this paper, news comes. News, we know this news is related to this stock. It comes to the model. We have some processes later, we talk about that. And it predicts the direction of the return for the next day. And we do it for all the news coming to the market per day. Past 24 hours, the news they come, and we forecast that they come together, and we forecast the next day direction of return. So there are different ways to do that. One way is using like chatbots. Of course, it's possible to do that, like dealing with, GPT models or, OpenAI models or the other models. Ask a question how this, news is impacting the next day excess return, but we are not doing that. We are making more, deterministic approach here following the written share. So the way we do that is we extract, there are different layers in these models with different reasons, tasks. One of the important layers is the last hidden state embeddings in all of these models. So we pass this news, we extract the information from there, and we do some averaging, and we have some bunch of numbers. This is deterministic. It means it doesn't matter how many times you pass this information, your text to the model. It's not changing the output. And this is really important for us. One of the problems we have when we want to use these models for trading, that output is always changing. Like you ask a question from the model and each time it's different, the answer. Sometimes they are quite diverse. Yes, we can do averaging and the other things, but it's not deterministic. This way, we can make the model deterministic, large language models. And we pass it to a simple linear regression. We can use different models, and we train these models now. So this LLM, any model, is just a translation layer to convert news to numbers. And after that, we can use it for making a small model like, logistic regression or any model, neural network, simple regression, estimate it and use it for trading. For each year, we make a new model, and for, as I said, estimate this model, return prediction model, and the output, as I said, is direction of the return here, but in the next paper, it is the continuous value. Here, we are talking about the direction, and we compare it with the different models. As you see, a long list of the models, we had the same strategy, and we compared our models. The first thing, when we focus on classification performance, the performance are quite similar to each other. These models are the big models in the market with many, many parameters, huge. But it's interesting, we call the are model fintechs here. And as you see, most of them are near 51, 52. And even if it is 52, it's not a statistically significance, the difference. So they are quite performing close to each other. Interesting. We moved to the portfolio and we found that our a small model, fintechs model, when we have equally weighted portfolio, as you know, some of you, we compare the portfolios mostly based on Sharpe ratio. When we have a better Sharpe ratio, it means the return is higher and the volatility is lower. So that's, with less amount of risk, we can gain better return. And interestingly, fintech is a small model with a small amount of data that we ran it with just one GPU, but because it was the specialized, the data inside of that, it's reaching the highest Sharpe ratio compared to these big players in the market and also financial models. Same thing here during time from 2007 to 2023, it's reaching a really good cumulative return, and it's quite close to Llama 2, but in most of the cases, it's higher than this one. Interesting. We made our own model and we are beating the other models in the market, that those popular models. We went ahead, okay, let's see whether this is coming from the market or this is information in the market, or it is giving us some extra information. For this case, we can have different popular factor models in the market, like Fama factor 3, CAPM models, and we found that the R squared is quite low here and the excess return is quite close to alpha. It means in a simple way that there are some genuine new information there, that those popular factors in the market like momentum and other factors, they are not capturing it, and it's coming from these models. That's interesting. It means there is some opportunity here probably to make money because this is new information. We try to do many tests here, moving to the, testing these models to see whether, okay, after forecasting 2007, I'm using my own 2006. What if I use an old model like 2007 that just saw the data until 2007 and apply it on all layers? We found that the performance is still really good. You don't need to even make a rolling model. You can use the old data, but make a specialized model, and you can reach a really good performance. We focus on lookup bias. I don't want to open it that much because I want to focus on the next paper sooner. But the main finding, we had different tests at language level, at classification level, and at the trading level. In this context, we talk about that, in this deterministic, clear context, we found that at language level, you can see some lookup bias. Like here, Trump. These are, we call it word embedding, how, Trump is presented in these, historical large language models during time. As you see, we have a cluster here and we have another cluster here. These clusters are mostly the years after Trump ran for president, the first term. And the right-hand side is the years before that. Trump was in news before or after that together. But as you see, there are some informations coming here that make these years separated for this token. We can have the same behavior for SONA, for Brexit, when we had election, before and after that, ESG. So we see some patterns of lookup bias at language level. But when we move to the classification and portfolio level, we didn't a clear pattern there. Again, this is not generative model. This is not chatbot. In this context, we didn't find it really, something that brings challenge for us. But at language level, linguistic level, it is there. And that can bring some attention for us, that we have to be very careful when model becomes more complicated. From the language level, they become more intelligent, and these lookup bias can have more impact. But in the simple way, we didn't find a real impact on portfolio. And because models are smaller, we can have some explainable AI test here. So here I'm showing you what these models are using from the text data to make short portfolio and what terms they are using for long portfolio. You see, it's using resignation, petition. So it has some understanding about this negative news. Mostly short side as this is better than long side, and the performance was much better, and the words it is using is more clever compared to the long side too. So this gave us a foundation about what we are doing. We did this study and we thought, okay, let's make it larger. Now there is another competition for making time series foundation models. These models, we talk about LLMs, so much data, large models. They brought the same concept in time series forecasting. They thought big companies like Amazon, like Google, they have their own models, IBM, and all most of the companies now they are competing in this area too. They thought, okay, we were able to make a really, really large model with billions of parameters and so much textual data to make an LLM. What if we do the same with time series data? Can we make a really large model based on similar architecture and put all the time series data from different areas we have together to make a single model and use it to forecast everything with any frequency? This was the concept, same concept we had in LLMs. They have their own benchmarks. They are competing with each other. They make the models publicly available. They are selling their models on their servers like Google. It's like production ready models now. They're updating the versions every few months. So we thought that, okay, many people are using, but nobody is testing it properly. Like the first paper, we really try to test it in a proper way and we make our own models too. So we try to do that here. Variety of time series models, foundation models or TSFMs at different levels, just using them. We call them zero shot, fine-tuning them, and finally making our own models too. Because finance is a really good area, challenging way to compare these models. So what models we have? The more main focus is from Chronos, from Amazon, and Times FM from Google, but we tested on many other models at zero shot level too. So as you see, these are the other models, the benchmark models we talk about, that they are really important in finance for each paper. There we have Finbert, we have Farm Predict and different kind of large language models. Here we have OLS, Lasso, Ridge, ElasticNet, PCR, decision trees that are quite popular. And also we have time series foundation models. So as you see, they have much higher number of parameters here. So this is a big difference in size. These are so small and these are so big. But do we really need this kind of large models in our case? This is the question we try to answer. So of course, when we have a large model like that, you need GPUs, servers, you need so much data, especially when you want to pre-train these models. Pre-training, it means making something from scratch. It's rarely it happens in the market. Like before, we have the same thing, a statistical forecasting metrics, and also we made same kind of portfolio here too. So I don't repeat it because we did it before, we talked about it. Like before, the first paper, a strict chronological training. Each year we make a model and use it to forecast next year. When, of course, we are pre-training. When we are using their models that's publicly available, we just download and use it for all years. We use around 50,000 GPU hours from Isambard AI. We were in the early stage access. That's why we had this kind of access to test the server too. So it is really computationally intensive to do that, and nobody needs to repeat it. They can just see what we achieve and try to continue. So the whole point was that doing something and have some understanding in these about these models and publicly make them available. What is the case? So simple, like before. For the first paper, we were using text data to forecast next day return or direction of return. We are using here past history of excess return or returns of the stocks, different windows, 5 days, 21 days, 252, and 512, univariate, nothing else, just that to forecast next day excess return. We make one, when we have models in the market, we just use it in zero shot. But when we want to make our own model, we put all data in a US stock market together to make a single model to forecast all stocks. So it's like that. From 1990 to 2000, we put all excess return together with different window sizes, make a single model to do forecasting for next year for all stocks in US stock market. There are some informations about the data size here, as you see, for estimation or training. For 2000, we make a model. Now you see number of securities. It's the entire stock market, with some, of course, cleaning, penny stocks and the other things that we applied those pre-processing to. So it's like a huge test. And also we extended this idea to other markets too. They were claiming that you can make a really large model with so much data. So US data maybe is not enough. Maybe you can get better performance by putting all markets around the world together. We did it. We put around 90 markets together to make a single model to forecast any stock market. Does it work? Let's see. You see the size of data here. The first year we start using the data was 1990, because before that, as you see, there are not that much data and the quality of data was not good. So we have one model. The first model is 2000, using data from 1990 to 2000 to forecast 2001. And we expand this window and going ahead until we reach 2023. And this is our evaluation data for the time we are applying it on US stock market. We are testing the models in total for 10,000 securities, the reports I'm showing you later, and around 18 million excess returns. So it's a really, really large case to compare the models. As I said, like before, we need good group of benchmarks. We have these benchmarks here: conventional AI models, deep learning, linear models, to compare them with them. Otherwise, it becomes just comparing models with each other, TSFMs. So really, fast way, if I want to describe the results here, these are the portfolio results with different window sizes for the benchmark models. The first thing we found for this larger scale study was that decision trees, they work very well. So Cat Boost, Light GBM, these are the models that quite popular, has been quite popular in AI world, and still they are performing really, really good, and they're computationally feasible to run. We found Cat Boost as one model that keep it as a benchmark because it's reaching the highest Sharpe ratio compared to the other models. So this is the first layer. Okay, Cat Boost is the best model. Let's go ahead. Let's compare this Cat Boost, or we call it benchmark now, with all other models in the market. Sharpe ratio better. As I said, higher is better. Ignore the other one. Just focus on Sharpe ratio. Here for the Cat Boost or benchmark, we are reaching around 6. This is daily rebalancing portfolio every day for entire US stock market. So it's expected to reach this Sharpe ratio with variations of the stocks, many small cap stocks. So Sharpe is high, but this is just a comparison. We are not proposing a trading strategy. First thing, none of the TSFMs that are working. Most of them, they are hardly reaching half of the performance of the benchmark. This is really bad. There's a claim they had is that you can just apply these models and make so much money by trading or forecast energy prices, forecast, weather. But at least for finance, when we go deeper and deeper, none of them are working. And in some cases, the Sharpe ratio even is negative. That's really bad. Even a simple linear regression model works better than that. So the hope for just using these models, at least in finance, is not there. We tested other models, from Moment, TTM, Toto, from different companies. Generally, we found the same pattern, but some of them, they showed some signs of generalization, like Toto, like Llama. Still are not reaching benchmark, but they are promising. We tried to fine-tune them. It didn't work very well, too. So even fine-tuning that they promised, it helps the model, it was not helping. We moved to pre-train. Now we reached the point that, estimating other models here, we use our own data, but their architecture to make our own models. So these models, they are not using mixture of different kind of frequencies. They are just using past history of stock returns. Now the models, they started working at least positive, much better than Sharpe ratio. It's not reaching our benchmark, but it is working, It's not useless model, at least in this case. It was a good sign that, okay, the architecture is good, but the way they are selling it, one model to forecast everything, at least in finance, is not working. And still, there are many limitations as we talk about that. They are quite computationally intensive. As you see, when we are training or estimating other models, it takes 10 hours, 20 hours, but suddenly for these single models, we reach 50 hours, 60 hours. So even on GPU, you need to have access to farm of GPUs. So it's not still, competitive, but it is promising. One of the promises we had was, okay, so more data. Maybe if we add more and more data, we can make these models better. So we try to expand, as I said, our data to global data. Next layer, we try to expand this data with 90 countries and bring all the factors from financial reports around the world, KP factors, inside of the model for training too. We found that, yes, it is improving performance, but it's still not competitive. It's not reaching the benchmark. So more data helps, but it becomes quite computationally intensive, everything we do. So many bottlenecks still. Slightly it improves the performance. We try to have more understanding about how the performance is changing during time. Here you can see Sharpe ratio. As I said, high Sharpe ratio is better for trading, for portfolio comparison. So during time, interestingly, all the models, doesn't matter, you are using a simple model or very complex model, all of them, the performance is going lower and lower. It means if you were using these AI models 20 years ago, the chance you gain some, profit there was much, much higher than now. Now, more, traders, hedge funds, they are using the same models. And of course, even, for the chronos, like our model, you see, during the last few years, the performance is kind of become quite near zero, the Sharpe ratio. So as you see, during time, all of them, they are losing the performance. Finally, we try to do something else. Okay, if we deal with these AI models, TSFMs, like the way we deal with other models, simple models, linear regression in the model, usually we tune many hyperparameters there. We have validation data. Okay, let's change this hyperparameter. The performance becomes better or worse. If we do the same with these TSFMs, so we found that the architecture is important. If we try to change this stuff, does it really help? The answer is yes. The answer is that the architecture, when we make it more matched with the time, like excess return in this case, we see better performance even without increasing the size of the model. And in many cases, now it passes the performance we reach from the best AI model or MN model that was CatBoost. So the promise is there. Architecture is really good. It's promising, but you need to tune it for the task you are working on that. And the promise that you can just one model to forecast everything with any frequency, it's not there, at least in finance. We try to expand this analysis. Everything is in the paper. Different countries, trading with those global models in different countries. We found the same evidence. Zero shot is not working, fine-tuning limited, and pre-train, our pre-trained models substantially increase the performance, but it's still not reaching the benchmark performance. And yes, that's it. So I try to, in a really brief way, cover two papers. Of course, the main focus for TSFMs, but because they shared the same, framework, I thought maybe it's better to put them together for you. And the other thing that we found that, I forgot to mention is that there is another big difference between especially time series foundation models and conventional time series forecasting models. Like LLMs, that you need to provide so much information for them when you are asking questions. They are quite similar. You have to provide long window of data, like hundreds of days for forecasting, return in next day of one stock. They are not working with like 5 days or 20 days. This is not the case with conventional time series models we have, or ML models. For these models, they need so much data. And this is another, weak point of these models that we have to consider when we want to use them. So we release all the models. Of course, as I said, these are not the most promising models we see in the market, but we have to start studying them. So all the models we pre-train, all the codes, everything is on fintech.ai website. We have our GitHub, our Hugging Face podcast, some videos, on the fintech.ai website that it is, reviewing the projects, how we are extending. Now we are working on multi-models, same direction, but try to mix different modalities for return prediction. Of course, the same task again, but from another view that we focus on text, we focus on time series data. What happens if we try to mix these from different, institutions? We are working on that to develop those models too. Thank you so much for the time, and I'm here for any question you have.
Thank you so much, Eghbal. Really nice what you have been finding in the most recent papers. Uh,
Thank you.
Good. So far we have some questions. Let me. Most of them came from social media. Let me see. Um, Here from Trista Ha. Why is finance so hard for these models?
Uh, that's a good question. Forecasting in finance is really challenging. That's the main target. All the hedge funds, investment banks, they are focusing on that. The reason is the noise in the market. There is so much noise, but the signal is really, really small. These models, they have to be able to learn the signal and ignore the noise in the market. So if we want to call one of the most challenging thing, we have for forecasting finance, stock market is one of them. When we have higher frequency, it becomes more difficult. It becomes noisier, the data, more challenging. And that's why, if it was easy, all the people, they were making money now because they were able to make a simple model and forecast everything and do trading. That's why rarely people, they make money, or most of the people, they lose money in the stock markets, because it is really difficult and challenging to have a forecasting model in the market that works well, have a problem. Some of them, they just show good performance, a statistical performance, but when you move to the portfolio side, practical side, they are not working very well. That's why it's a really good horse race for any model we have in the market that's developed for something else, and now we are trying to apply it in finance.
Makes sense. And just for to clarify, like, what are the strongest signals that usually the models, like, I don't know, that you can find, or
I
like,
mean, it depends on the model and data you are using. One of the things, as I said, these models are, TSFMs, we were talking about that. They were using just past history of stock returns. This is the minimum thing we can fit to the model. Usually, to get better signals, we try to mix data, alternative data, text data, image data, satellite data, everything comes and related to stocks. So when you move to the narrow area like that you don't provide that much information for the model, just past history, just news like first paper, and you expect the model starts to trading and you compare them. That's why it makes a really challenging case for these models, because the information in past history of the stock returns is already assimilated in the market. It's in the price. There is not that much there to use to forecast a stock return. That's why we have multimodalities. We have we are moving from univariate to the higher levels of at the same time using different data sets to forecast. So more data, more variation, better signal.
Okay, makes sense. Nice, nice. So let's go with the next question from Ronnie Palm. If many investors start using similar models, could those models stop being good because everyone is following the same signals?
This can be one reason. It is interesting that when I came out with this paper, I didn't expect most of the interest comes from industry, because at least I have been presenting this paper for 4 or 5 hedge funds now. They asked me because they were working on the same model. So if we want to talk about who jumps first when new model comes to the market, those are investment banks and hedge funds, not researchers in universities. This coming from my interest when I do this stuff, but this is not a trend in academia to you test the new generations of the models, because it's still not established. So yes, the answer is it can be not 100%, of course. There have maybe many factors there that one model or one approach losing its performance, but one of them, or maybe one of the major ones, can be, of course, more people they move there, and if there is any signal they start using it, and gradually it goes away. That's why when, as I said, it's not just about this forecasting. If we come back 20, 30 years ago, trading in market was much more simpler than now. You were just buying something, keeping there, and making profit after a few years. But now there are many factors happening in the market. Many, high frequency traders, algorithmic trading, they try to make profit from small changes in the market with their models. More difficult, of course, except you are focusing on really long-term investment.
Yeah, makes sense. And one question, this is from me, but what if you have to choose, like you mentioned that there's no one model for that could work for everything, but if you have to choose one model that help you to have better forecasting, like which one will you choose for future investments?
So again, there are many considerations here. What data you have access to. When you are really trading in the market, you need real-time data. The data we are using here is mostly like historical data. Real-time data is, of course, expensive, and the frequency they provide it is really important too. All of these factors, the frequency you want to trade, the data you have access to, type of data you have access to, then the computational resources you have access to, they choose the model you have to follow with that. And always when I want to choose the model, I start with the simplest one, because we need a simple benchmark. Otherwise, the horse race is just comparing some models with each other. We need something established. This is linear regression. This is neural network, and it's working well, fine, at least. Okay, it's not working well, so we try to beat it. So the benchmark should be always their simplest model in the market, and we start playing with these considerations. We have to add more models, and if I want to choose one model, I don't jump to really trendy models. I start with more conventional models to build something, and after that I try to improve it in very small percentages with more innovation or more challenging areas. But I don't make a system based on something that's not really established now.
Oh, that's really interesting. Yeah, makes sense. Like choose one strong foundational model and then train overall in the specific area and then make it efficient, like
Yeah,
marginally, till you are on top of the game.
yeah.
Oh, really nice. I think that's for all the people around there. I think that's a great answer. Good. Let's go for, I think, the last question so far, unless somebody else write it down, from Patty Bear 6. Why 20 years ago those models could work better than nowadays?
There are different things here. One side, as we talk about that, is that these models, they were not available 20 years ago. Most of them, they came during last few years. So we are applying something to 20 years ago data that nobody was using these models that time. So it's not reflected in any prices. They were not a forecasting model like that. Non-linear models or something like that. They were really rare in the market. This is one thing. The other thing that I think it is important is this is one side, and the other thing is the name. It's not about all the models. Market, they become more efficient during time. More traders, they join to the market, hedge funds, investment banks, and in general, doesn't matter which model you are using, there is less information in the market to use for trading. This is a pattern. It doesn't matter. It is OLS. It is, complex models. One side is that one too. So these are two, I think, and there are many components there, but two main components that they come together and make it more difficult to use these models. So if we come back like 20 years ago, as I said, it's possible to make money in any market, not just financial market, easier than now. So I think it's like expandable to any kind of business that 30 years ago was much easier than now. And financial market is the same. The difference here is that we are applying some models here. Doesn't matter. Market is more difficult to trade.
Yeah. Okay. Perfect. Oh, and then I have another question, which
Mhm.
is, how do you see the future of finance in the next 20 years? Like where everything is moving, what do you expect? Maybe it doesn't have to be that strong, or maybe you don't have a paper about it. But how do you visualize?
It's really difficult these days to visualize something like that. Even in AI world, when we want to visualize next few weeks or months, it's really blurry. It's not really clear what models with what capabilities they are coming. So I think it is really linked to the advances we have in the AI now. Most of the things that are coming from the companies, new models, and we try to follow them. I think the grow or the momentum is much slower now compared to the 2 years ago. So I don't expect some breakthrough happening in next few years in AI world. And I think the improvement becomes much smaller. I think we see the same thing in the finance, that we want to use these models and from the paper that comparing these models for trading, we become more detailed about how now we can improve these smaller models, how we can gain, with smaller changes, we can make better profit or better performance. From a really, big picture, now we become more detailed. The same thing we can see in the AI too. They try to make the models they have slightly better and better. They are not like making something really totally new. So I think at least in 5 or 6 years, next 6 years, we are going to this way. Finance is still there, the foundation is there. There's many of these models are foundations. From a French model, it's not changing. From a French model, suddenly it doesn't become an AI model. But we try to improve all these aspects using the new tools we have. So foundation is not changing, it's there. And some layers of improvements are coming on top of that.
And just a following question. And what do you think will happen with the investors or the companies that do not adopt AI as the big ones or as the top players? Are they going to survive, disappear, adapt? What do you think?
I mean, it depends on about what hedge funds or investment banks you're talking about. That their culture is different. Some of them they are really long-term investors. They don't really need to use these top-notch AI models to forecast next 20 years. They are mostly focusing on fundamentals. Not really forecasting daily stock return. Those they are doing their work, they are doing very well, most of them. We come back to the algorithmic traders or this kind of the part of the market that's focusing, and that's a small part of the market compared to the long-term investors or mid-term investors. And even then, they are quite cautious. It doesn't matter what model is coming to the market. We are talking about money, people's money. We have, from my experience with the companies, is that they have some ongoing safe models that is working, and they try to really don't invest that much money, a small part of their portfolio, to play with that with this more advanced model. When they reach a acceptable, level of, confidence to the thing they have, they try to replace. This is not changing. This is there because we are dealing with the money. We are not dealing it. The thing I'm presenting for you, when it becomes in practice, we are talking about losing or gaining money. In one day, you may lose everything you have, when it's not working well. So I think most of them, they are going in the right way if they keep the foundation and try to do improvement and not jumping to the something that is kind of not really established, but play with that. And I think that's a good path. If you totally want to move to something like that, of course, your risk goes higher and higher, and especially now that everything is changing so fast.
Makes sense. Totally makes sense. Good. So really interesting. Your papers, like your presentation, really on point. Give me a lot of insights into all the audience about where everything is moving. So thank you so much, Egbal. So where I'll I'll share your here that you have, if you can tell us again like what they can find here.
Yeah, all the things they need for these papers is accessible through our portal, fintech.ai. All the links in GitHub, Hugging Face, podcast, videos, they can have access from that website. And we are always updating this website when we have a new research, make everything open source as much as possible, benchmarks, so people they can use, they can test everything we are working on.
Amazing. Good. And also all your future papers, they can find it here.
Yeah, yeah.
Amazing, Egbal. Well, thank you so much for your time, for your presentation. Now that good luck in your, well, you already had your presentation in London, but good
Yeah.
luck in future presentations. And we
Thank
are
you.
really happy that you had time to share with us all your knowledge, all your research, your experience. It was really amazing.
Thank you for the invitation.
Thank you. Well, and thank you all the audience. See you next time. Bye.
Bye.